Real quick, before we get into the show, I wanted to share a new service called Getita that Ken and I have been using that has made us over $10,000 in Amazon reimbursements. The service requires no monthly subscription, and Getita collects a small percentage of the money they recover for you. It takes less than 5 minutes to set up and works on all Amazon marketplaces. Go to Getita.com, Getida, and enter promo code FTM400. That's FTM for Firing the Man 400 to get your first $400 in reimbursements commission free. How much money does Amazon owe you?
Last year, 350 of those brands were acquired by aggregators. And we forecast, as do our buyer clients, that'll be at least 1,000 in 2022. So that's a significant step up, as a lot of these aggregators are still just over a year old. And so they're now becoming big enough and bold enough to acquire 40 companies in 2022 instead of maybe just 10 last year. So it's incredibly hot. There's going to be a lot of M&A activity. Earnouts, I don't like. But in some cases, you can understand why buyers might insist on it. Depending on how competitive the auction process is during the exit, if it's very competitive, you have more power before you sign an LOI to try and have more upfront as opposed to less. So 100%, the winners in this space will be the operators, not the M&A geeks like me. So what we do is we have two work streams. The first is operational improvements, and the second is corporate finance improvements. So on the operational side, one of my co-founders is an e-commerce expert, and he works with our clients to improve all the operational aspects with the viewpoint of the buyer in mind in everything that one does. Right. So ultimately, it's all about getting a really good exit. So and we know what that means. So we do oversee and advise on all the tweaks you can do on the operational side.
Welcome everyone to the Firing the Man podcast, a show for anyone who wants to be their own boss. If you sit in a cubicle every day and know you are capable of more, then join us. This show will help you build a business and grow your passive income streams in just a few short hours per day. And now your hosts, serial entrepreneurs David Schomer and Ken Wilson.
Welcome, everyone, to the Firing the Man podcast. On today's episode, we have the privilege to interview Emmett Kilduff. Emmett is the co-founder and CEO of the Fortia Group. Emmett has had a strong interest in e-commerce since he completed a master's in e-commerce way back in 1999. With over a decade of leading M&A firms at Morgan Stanley and Credit Suisse, Emmett has brought billions of dollars of acquisition experience to your e-commerce exit strategy. We are very excited to have Emmett on the show today. Welcome, Emmett.
Thank you for having me.
Absolutely. So let's start this with a quick background on your life story and experiences and how you got to founding the Fortia Group.
Very good. Well, as you said, I did a master's in e-commerce back in 1999, which is a terrible amount of time ago. Makes me feel very old. But at the time, your listeners will remember there was a dot-com boom. So having done that e-commerce master's, I wanted to get into an investment bank to do all these IPOs. The dot-com IPOs was the place to be at the time. And so I joined Credit Suisse at the time, who had a leading franchise doing literally all the dot-com IPOs, Amazons of the world at the time. And enjoyed the world of investment banking, but my father was a tech entrepreneur, so I didn't want to grow old in the ivory tower of an investment bank. I always wanted to do the entrepreneurial route. And so I left Morgan Stanley, one of the biggest and best M&A firms in the world, which we might come back to do a data startup back in 2012. So I'm executive chairman of a data company called Eagle Alpha, which helps hedge funds, private equity firms, and actually some aggregators use non-traditional data in their decision making. So for example, it could be web crawl data, satellite data, shipping data, and so on. And it was through that journey that a hedge fund based out of New Jersey invested in Eagle Alpha. And the guy that led the investment happened to be best friends with Carlos Cashman of Thrasio. So sorry, that's taken a while to get there. And that chap, Tom Copeland, actually also invested in the seed round of Thrasio, which has an incredible returns. And when I spoke to Carlos, I got really excited. This was back in June 2010, quite early on in this whole journey of aggregators. I got an early glimpse into this new world. And having done a decade in investment banking and M&A and a decade in data, it just made perfect sense to me, what all these aggregators were doing. So I moved from CEO of executive chairman of my data company, Eagle Alpha, to free up time to start the Fortia Group. And the Fortia Group sort of brings me full circle back to the start of my career in investment banking, because what we're building here is we want it to be the Morgan Stanley or Goldman Sachs of e-commerce. We want it to be a proper, prestigious investment bank to help e-commerce entrepreneurs ultimately get their best exits.
Very nice, very nice. And that is quite a background to get you to where you're at now. So so the listeners know, your typical clients would be the sellers. So you're operating on the sell side?
That's correct. Yes. We typically work with e-commerce entrepreneurs that have companies worth $1 million all the way up to $100 million.
So Emmett, thanks for sharing your story and your journey. One quick question for you before I move on. So you graduated with a master's in e-commerce in 99. And so if I don't want to date myself, but in 99, I'm thinking graduated with a master's in e-commerce. And then just a few short years later, there was this thing called the dot-com bust. So how did that propel you, and did you pivot or did you just hold tight? Or because the dot-com bust, for the youngsters listening on here, it was a pretty big shakeup in the realm of the e-commerce space.
Absolutely. And at the time, there were people just with PowerPoint decks raising insane amounts of money to fund their vision. Actually, a lot of the businesses that were pitching back then, actually, since then have succeeded. A lot of them were just too early in their journey, food delivery being a great example. But the IPOs continued after a reset of the markets, but probably back towards more normal industries or sectors, not the racy, .com businesses. Having said that, in the last decade, clearly the internet, there's just a lot more capacity to have successful internet or e-commerce based businesses. So now is a good time to be doing e-commerce IPOs. But yeah, in the early 2000s, it was tough.
Yeah, absolutely. Well, cool. Yeah, I love history, and I thought it would be good to chat about, that space there. So fast forwarding to now, 2022, what is the kind of the current state of the market with e-commerce, M&A? What's going on there?
E-commerce M&A at the moment is incredibly hot. Maybe if we break it down into DTC and FBA, or Amazon and DTC off Amazon. On Amazon, it's incredibly hot. Why? Because there's at least 93 Amazon-focused aggregators in our CRM today. It's increasing every week. They've raised $13 billion that needs to be deployed by acquiring Amazon brands. Last year, you've probably seen the Marketplace Pulse research that came out this week saying there's 60,000 brands with over $1 million in revenue. Last year, 350 of those brands were acquired by aggregators. And we forecast, as do our buyer clients, that'll be at least 1,000 in 2022. So that's a significant step up, as a lot of these aggregators are still just over a year old. And so they're now becoming big enough and bold enough to acquire 40 companies in 2022 instead of maybe just 10 last year. So it's incredibly hot. There's going to be a lot of M&A activity. That's on Amazon. If you look on DTC, Shopify, etc., one of the interesting trends there is it's becoming really, really hard to get venture capital financing because of the iOS changes last summer and various things. And so a lot of businesses that thought they were going to get financing, equity financing, are turning towards an exit maybe sooner than they'd like. And in some cases, maybe distressed. So in those instances, it's a buyer's market. But back on Amazon, if you've got 20% net margins and you're growing well, and given all these aggregators coming in, it's the seller's market.
Yeah, that's really interesting. Two things you mentioned there I'd like to notate. That sounds like that there's going to be a huge ramp up this year. Like you're forecasting, the market's forecasting to triple from acquisitions last year at 350, I believe. And you said, close to 1,000. That is huge, which I'm sure I'll leave the valuation stuff and everything. I know David's got some follow-up questions on that, but I would say that's going to have implications on that because it's heating up and there's a lot of demand, right? And then there is a limited supply, which it sounds like there's a lot more opportunity. That Marketplace Pulse research that they showed that, yeah, the numbers are there. And so now it's just a game of racing to get those numbers and duking it out on the way. Another thing, you mentioned the DTC side of the space. with the Apple update, and we've had a couple guests on the show that really dove deep into that and the implications of that. And so, the Shopify stores and the DTC stores are really, so it sounds like they're kind of hitting the reset plug, and there's a lot of shakeup there until they can figure out the acquisition strategy of the next 3 to 5 years, so cost of acquisition and how to do that and move those marketing dollars around. So very, very good insight there. David, I'll kick it over to you.
Yeah, can we touch on the valuation side of things? That's something that we've heard a lot about, valuations increasing and multiples increasing. Can you talk about that?
Yeah, I think if we start with DTC off Amazon again, because generally if a company has got good growth and is profitable, you can be in the ballpark of 10 to 12 times EBITDA, which is higher multiples than what we're seeing on Amazon even today. If we look at Amazon FBA businesses, before Thrasio was around, it could have been 2 to 3 times STE, which stands for seller discretionary earnings, which is like net profit or EBITDA with various add backs. The 2 to 3 over time became 3 to 4. Today, and we did a evaluation webinar in December. The typical range is 4 to 6 times STE upfront across everything we're seeing, all the data points, what we're seeing and what aggregator clients are seeing. It's going to, one of my predictions for 2022 is the evaluations are going to increase and decrease, which sounds slightly strange, but bear with me. It'll increase for those brands that have high revenue growth and margins are continuing to grow, are in the 20s or 30s. And they're the diamonds. And all the new aggregators are searching for those diamonds. However, there's a lot of brands that started 2021 with net margins of maybe 20%, but finished the year with net margins of 15% because of supply chain headwinds, PPC headwinds, et cetera, all the items I'm sure your listeners know about. That's tough for those guys. They're going to be stuck in the valuation rate. Their value won't go up this year. If anything, it might go down. So there's a diversion, for want of a better word. The diamonds are going to continue to grow and the valuations will outpace the average, but there'll be a large number of brands here that may say, you know what, I'm not going to sell now. I'm going to fix this. I'm going to wait for freight costs to reduce, and I might go to market in summer 2022, but not now. So there's some of my thoughts.
Absolutely, absolutely. I remember about 2 years ago, and I'm curious your thoughts on this. I remember 2 years ago, was still working at a consulting group. Our primary clients were private equity funds, and you'd see a lot of deals done at that 5 to 7 times EBITDA. And as I learned more and more about the aggregator market, and we're hearing about companies selling 1 to 2 times earnings, it was puzzling to me. It seemed kind of like a market anomaly. And if I put myself in the shoes of a buyer, cash flow is cash flow. I mean, certainly there are differences about an Amazon company relative to like a brick and mortar. Namely, I think they're much more lean. And so do you think, I believe that valuations are getting to where they should have been a while ago. Do you agree with that?
Yeah, I think for very small businesses, I think valuations should be low because there's still a lot of inherent business risk. But especially as you go up the curve, businesses get bigger. Then actually, you mentioned the word private equity. Private equity are starting to bid for a lot of these companies. And as you rightly say, they're used to paying much higher multiples than are being paid today. So I think for businesses that are worth more than $10 million, then private equity should be bidding for them, not just the aggregators or other types of buyers. And that can drive valuation. But as you come down to the smaller levels, if it's a 1 million, 2 million revenue business, there's still a lot of risk. On Amazon, the business doesn't own the customer. Therefore, it wouldn't be as valuable as a DTC business. So there's some thoughts. I think overall, over time, valuations will increase. I just think right now there's a dispersion.
Very nice. Very nice. So you had touched on the impacts of COVID, and Ken and I as operators have seen both positives and negatives, right? We have increased shipping costs, tariffs in place that really makes having a strong net margin difficult. On the flip side, you have people in quarantine. You have a lot of people that have never bought online that are now buying online. It seemed like it is not a generational thing. We have people in their 70s and 80s buying on Amazon just as people in their 20s and 30s. And so would you say with the companies that you've worked with, that when you net these out, the positives and negatives, was COVID a net benefit or a negative impact?
I'm very much a glass half full guy, so I'm going to go for a net positive. In all seriousness, I think it's fast forwarded the whole, e-commerce adoption, which you're alluding to, which is great for e-commerce entrepreneurs around the world. So more people are logging on. Yes, there's been ebbs and flows as people are allowed back out onto the streets and the restaurants, but more people are using e-commerce, which is great. There has been difficulty. Supply chain has been difficult. Comparing numbers in the last 12 months to the prior 12 months has been really hard because there was such a big bounce, and it's tough to do that on a relative basis, and it's hard for buyers to sort of see through that and try and estimate what normal demand will be as the world readjusts or normalizes. But overall, I think it's a positive. Bringing it straight back to M&A and exits, we have seen people in Q4 just not want to discuss exit. They're just hunkered down and trying to execute and trying to finish the year. And then when they get to January, they think, right, am I going to sell now? And if they do, we've had a flurry of inbounds in January and February because it's a quieter time of year and people are thinking about the year ahead. But I think a lot of folks are going to try and repair their financials before they come to market so that they don't get penalized. So they're not at a 3 or 4x, it's worth putting in a year's work if they still have the energy and the motivation to get towards 5 and 6x, maybe at the end of this year or early next year.
Excellent. And so, Emmett, I'd like to dive into a comment you made earlier. You were kind of given the broad valuations for, let's say, an Amazon FBA business where it was kind of that 3 to 5, 4 to 6. And then you had mentioned DTC multiples are in that 10 to 12. So one thing that Dave and I, we really focus on in our portfolio companies, and a lot of our peers are focusing on, is kind of taking that native FBA business and really adding in a DTC channel and kind of scaling that and kind of growing that. Where do you see in the market that needle moving that multiple? Let's say, is it 50% FBA and 50% DTC, or what really moves the needle in that valuation on the blend of, say, marketplace or customer acquisition?
Yeah, it's an interesting question. And I think taking a step back, all of our buyers are looking to buy proper brands that have longevity and can ultimately become multi-channel. They're not looking for just products that will only live on Amazon, because that's a finite total addressable market and dollar opportunity. So it's important that the audience, your sellers, realize that, because that's where you can get the best exits, brands that can ultimately go even offline. And to answer your question directly, David, I think the way we think about that is approaching valuation on a sum of the parts. So we'll look at the pie chart of your revenue, online, offline, within online, Amazon, versus DTC. We will attribute the right multiple to each of those. And then you add up and you get an overall blended multiple, valuation multiple. So even if it's just 30% DTC, you can argue and debate for, a higher multiple on that tranche of your revenue, because you own the customer. The key difference being you own the customer. So it has more value attributed to it, especially if you're getting good subscriptions and renewal rates, either even on Amazon or off Amazon. That can really drive valuation.
Okay, so just to wrap that up, kind of the overall reply was this: it's also like a sliding scale. So the more DTC you have, the higher you could argue for the multiple to go. Is that fair?
Exactly. The blended multiple, yeah, and so. It's not like there's a binary amount where you have to get to 40% DTC to use the higher multiple. I would as a banker, I would argue for some of the parts approach. So if you have 20% DTC that's going really well, then you should be getting a high value for that portion.
Okay, yeah, I like that. And kind of following on that same theme, what should owners be focusing on right now to kind of maximize the valuation for their business?
So the first thing I always say to that, and my key takeaway for any seller, is preparation. Fail to prepare, prepare to fail. It really frustrates me that a lot of folks are sent an LOI from a buyer on a Tuesday and are told it'll be void by Friday night if they don't sign. That's not preparing a business. If the entrepreneur has spent 5 years building a business, they should be spending at least 5 months preparing an exit, right? This is the big payday. And too many people rush into it. They don't do their homework. So preparation is key. We have something called an exit ready program where we work with folks that want to sell next year or the year after. And we hold their hand and make sure that all their ducks are in a row, all their prep is done. So when they do hit the green light on an exit process, everything is as ready as it can be, right? So preparation is key. The second is I'd focus on the margins, net margins. I'm not as interested in gross margins. It's all about the net margin, which drives cash, and that's critical for buyers. Typically, buyers want to see at least 20% net margins on Amazon businesses. If you're 15 to 20%, there needs to be sort of some low-hanging fruit for a buyer with deep resources to sort of get it from 15 to 20%. But the key driver of valuation multiples is margin, net margin.
Sorry to interrupt the episode. You may have heard Ken and I talking recently about a new tool that we're using for Amazon refunds. Now, I have used other refund tools like this. However, I can tell you in the first 7 days, they scrubbed the back end of my Amazon account going back 18 months and found $5,000 of refunds. And the nice thing about this is it's my money. Amazon made a mistake and they are just auditing my account. The other thing I really like about this tool is there is no monthly fee. They only charge a commission if they are successful in getting you your money. Go to Getida.com, Getida, and enter promo code FTM for Firing the Man, FTM400. This is an awesome tool. Can't say enough good things about it. Now, back to the episode. So let's talk about aggregators for a little bit. And to kind of set the scene for this question, Ken and I go to a number of conferences and, you see familiar faces. And it seemed like last year you snapped your fingers and there were aggregators everywhere. I remember at Prosper, they were giving away Teslas if you would refer a friend. And so can you talk about the impacts? I mean, first, why do you think there has been a flood of aggregators? And two, what do you think the impact of that is going to be on the overall industry?
Well, I think why has there been an increase in aggregators? This whole concept of a private equity type roll-up model has been around for decades. People have rolled up dry cleaners, they rolled up restaurants, right? The buy instead of build strategy has been around for decades. Amazon presents the most perfect buy and build roll-up opportunity in my experience of the history of Wall Street, in the history of finance, because of the operational leverage. As you said, a lot of these Amazon businesses are sort of one-person businesses. They're not like a DTC business that have different departments and a real office and a manufacturing plant. Amazon FBA operational leverage is crazy, which means integration is relatively simple. I say relatively. And so it's the perfect storm. There's a huge amount of money around. Interest rates are at an all-time low. So a lot of money that's looking to be put to work. We've had COVID giving the e-com bounce. A lot of these brands are acquired at low multiples. The aggregators wait for it are raising money at about 30 times EBITDA, not 4 to 6 times STE, right? So the arbitrage is incredible. There are some of the reasons why there's so many aggregators. Today in our CRM, there's 91 Amazon aggregators and there's over 20 DTC aggregators. A year ago, there was probably 10. I think what are the impact of that? The impact is there's 13 billion raised in equity and credit that has to be deployed. That's a lot of money to deploy, which is good for sellers, assuming you've got a good financial profile and a good brand. So it's very exciting. There's going to be huge activity this year. God knows what some of the promotions will be at Prosper in March. I'll be there myself to sort of see some of them. I hope it doesn't bring me back full circle to the start of the show where we talked about the dot-com boom. I hope there isn't an e-com bust. I don't think there will be, because I think actually the valuations are sensible. I think interest rates will rise this year, which will have an impact on the ability of the aggregators to get credit, or certainly credit at certain terms, which might affect valuations and various things. But yeah, there's some thoughts.
So to follow up on that, Ken and I have been kicking around the idea of exiting one of our portfolio companies. And one thing that has come up in conversations with, and I'm not saying all aggregators, but this has been my experience with a couple, is when I think of the skill sets needed to be a very successful aggregator, on one hand, you have the ability to raise capital. And on the other hand, you have the ability to either create a team or, operate the business on your own. And it seems like there's an influx in people with excellent skill sets on being able to raise capital, but that operational piece may be missing. And I worked in finance, and I've also operated an Amazon business, and they're different skill sets. And so curious what you think of that. And also, when I think of implications, what does this mean? Should sellers be more cautious, say, around putting a good portion of the deal value in earnout? Or what are your thoughts on this?
Well, on the earnouts were designed by buyers. Full stop, right? Earnouts favor buyers. It's a way to get the business to pay for the business. In the data we've seen, about 75% of consideration is upfront and 25% is deferred. If there will be an earnout component, I always encourage the seller to ensure it's based on revenue, which is cleaner and simpler than SDE or net profit, which can be manipulated, or there can be debates and arguments saying you didn't do enough marketing, therefore there wasn't enough net profit and all that sort of stuff. Earnouts, I don't like, but in some cases, you can understand why buyers might insist on it. Depending on how competitive the auction process is during the exit, if it's very competitive, you have more power before you sign an LOI to try and have more upfront as opposed to less. So 100% the winners in this space will be the operators, not the M&A geeks like me, right? And I think the best teams have a mixture of M&A folks from Morgan Stanley, Goldman Sachs, etc., and operators, ex-Amazon, or people who've built their own really successful brands. The game of just buying business, anyone can buy a business if you have the money. It's relatively simple to do. The hard part is operating these brands efficiently. And there's not enough transparency in our industry on how well aggregators do with brands. And that annoys me, frankly. And in 2 days' time, we have a webinar to showcase 10 successful sellers, but also how their brands have done post-sale, as a way to try and bring a little bit more transparency. And I've contacted tens of aggregators asking them, would you submit some of your sellers to participate in the webinar? And at least half have said, no, we can't do that. And it's really frustrating. It's like, guys, we need to open up. We need to show, you need to convince sellers that you're really good at what you do. And we need to get the journalists away from this concept that there's going to be aggregator death watch in 2022. And that, aggregators are not good at their job because they're M&A focused or because they're not operators. So yeah, but having said that, I think there's lots of brilliant operational teams I've seen and spoken to at these aggregators. And if they don't have it on day one, they certainly fix it really, really quickly because they've raised so much money they can do.
So Emmett, a follow-up to that, it was a great answer, by the way. And I definitely agree with you. I have a friend who recently exited, probably 6 months ago, and the specific aggregator missed the earnout payment. And so if there was a crystal ball, I would rub the crystal ball and I see some changes in the space in the next, 12 to 18 months, maybe shorter. And like David alluded to, it's easier for some to raise money than it is to operate. And so your point of transparency and how the aggregator is operating and how the brands they've acquired, how they are doing. And I think as a seller myself, when I go to market, and even if someone wins the bid at auction for the company, and it's like, well, I need to see how you're operating, especially if you mentioned at earnouts 25%. It's a way to grow faster, right? You can leverage the growth of the cash flow of the business to pay for it. I also think that, when you're raising money, Emmett, this, when you're raising and you're taking someone else's money, you have a timeline to deploy it, right? Because you have to show a return on that. And so I think there's a race to market. I think there's a lot of errors being made now. And, having said all that, what do you think? Do you think there's kind of a reset? Do you think there's, like, say, the Thracios and the Purchase, the large aggregators are going to kind of Are some of the smaller ones going to go belly up and they're going to, that space is going to kind of grow through acquisition of aggregators, or what do you think?
Interesting. Yeah, I think let's give some wiggle room to these aggregators for a second, right? Because a lot of them weren't around just over a year ago. So the pace that they've had to grow is incredible. And it must be incredibly tough from an operational perspective. I think 2021 was a year of rapid growth and learnings for a lot of these folks. And I would say over the holiday period and think during their offsites at the end of last year, at the start of this year, when they had a chance to breathe and regroup and think about, going forward, I'd say a lot of people were thinking, I'd say the word reset was probably used. If we could be a fly in the room of all those boardrooms, I'm sure it was used. And I know for a fact from speaking to some aggregators and observing their feedback that some people are putting a pause on deal flow. Some people are that said they were going to do some more DTC acquisitions have said, no, we're just going to focus on FBA. Some people have said we're open to like 60% FBA, 40% non-FBA said, actually, no, we're going to go 80% FBA, back to the core. So I think there are resetting going on. I think there were 3 aggregators up for sale last year, and they were probably more M&A folks as opposed to proper brand operators. They couldn't deliver the true score of improving the brands. And so I think there will be a small number of, call it, distressed aggregators selling this year. And then to your final point, David, this whole theme, the consolidators will get consolidated, has started to happen in a very small way. I think it'll really start to happen a little bit this year, but more next year and the year after, when the big aggregators will look particularly to pick off niches. So like this week, there was a first round of funding for an aggregator focused on South Korea, right? So that's very niche. So if that does well in 2 years' time, it could well be a super acquisition to plug the geographic gap of a big aggregator or indeed a private equity firm. So yeah, I think going forward, I can't foresee any Me Too copycats of Thrasio anymore. I think the market for that is gone. However, there will be lots of niche aggregators launching. By niche, I mean like focus on a geography, whether it's South Korea, India, LATAM, or on a category like wellness or beauty, or on a theme like distressed FBAs or small FBAs. I can see tens of niche aggregators launching this year and having a razor focused niche, and then ultimately those aggregators being bought by the big aggregators in time.
I really like your answer on this and in this part of the discussion. It seems very well balanced in between, cutting the aggregators some slack on the operations side. You had mentioned the reset period. And, I think of our own businesses. Obviously, Ken and I, combined 12 years experience of running Amazon businesses. We would have, if we were operators, we would have not met our earnout this year. Like we ran into the same issue, inventory restrictions. And does that mean that we're bad at operations? No, it was just a tough year.
Yeah.
And so I think that reset button, as we begin the new year is really good comment and something to think about. And I think before I asked that question, I may have been a little more doom and gloom about the prospect. And after hearing your response, I really do think that my opinion has changed on this and is a little bit more balanced. And so, no, we've talked a lot about this, but I really appreciate your thoughts here. So let's switch gears and talk about the Fortia Group. How can the Fortia Group, help our listeners and what type of business would be a good fit for your services?
Sure. So we help businesses in 3 ways. One is we provide a free valuation estimate of what the company's worth today, but more importantly, what the company could be worth in the future. And it's not driven by just inputting data and expecting a result immediately. It's a lot more thoughtful and there's careful, bespoke consideration to each potential exit and deal. That's the first thing. Second thing is we have an exit ready program. So for folks that are not ready to sell now and want to sell next year or even the year after, we put them on our program to make sure that when they do want to sell, the business is ready to get the best value possible. And going back to the earlier comment, I really urge people to be as prepared as possible, not to rush into an exit. For those folks that think they're ready for an exit today, we obviously can advise on that exit. We adopt a 7-step process, which is similar to an investment banking standard process. It's very intense. We provide a lot of bespoke advice. So, for example, in the preparation phase, we'll produce a 50 or 60-page info memorandum that goes into everything about the business. There'll be a full online data room in categories such as supply chain, finance, product pipeline, etc. There'll be a 2-page teaser. I won't let any deal go to market unless the teaser, the deck, and the data room are all to a Morgan Stanley or Goldman Sachs level of standard, because that drives everything. That drives the initial first impressions from all the buyers that would take a look when they get into the data room. So they're the 3 things we do. We can provide a free valuation estimate, an exit ready program, and obviously advise on the exits when the time is right.
That exit ready program, obviously all of the services that you offer, I think are incredibly valuable, but that exit ready program, can we dig into that a little bit more by starting with this question? If 10 sellers come to you and say, we're ready to sell, we're prepped, we're ready to go, and then you take a look at that company, out of those 10, how many are actually ready? And how many of them would have very much benefited by going through this program?
Yeah, that's an interesting way to look at it. I would say an entrepreneur always looks at their business with a glass half full and always expects it to be worth more and et cetera, et cetera. I would say at least half aren't ready. Either because their net margins aren't where they need to be, or the revenue growth isn't impressive enough. And I say all this with a view to like getting a really good multiple. So what we do is we have 2 work streams, and the first is operational improvements and the second is corporate finance improvements. So on the operational side, one of my co-founders is an e-commerce expert, and he works with our clients to improve all the operational aspects with the viewpoint of the buyer in mind in everything that one does. Right. So ultimately, it's all about getting a really good exit. So, and we know what that means. So we do oversee and advise on all the tweaks you can do on the operational side. On the corporate finance side, you have myself as an M&A guy, and my other co-founder, who's a CFO, a financial guy. We're thinking about the KPIs, speaking to the lawyers involved, speaking to your tax advisor, speaking to your CPA, your accountants, putting you in front of some buyers early on to get friendly feedback. And you bring all that together then, and we do monthly advice on a 1-year view, 2-year view. Then you're going to be ready to go and do a proper 2-page teaser, a 50-page deck, and thoughtful data room. And all of that will drive, the best valuation possible.
Very nice. Very nice. Yeah, I really like that. Ken, I'll kick it over to you.
Yeah, for sure. So Emmett, we're coming up on time. It's been a pleasure having you on the show and a great conversation, like really, really valuable. So we have a portion of our podcast that we run every guest through. It's called the firing round. Are you ready?
I am ready.
All right. What is your favorite book?
At the moment, it's called The 5 a.m. Club. I read it over the holidays and I pretty much adopted it. I don't quite start work at 5, but I get up at 5:30 and I start at 6, and I work 6 to 9 with no one disturbing me. And I get probably 5 hours work done in 3 hours. And so it's all about successful people getting up early and getting going early, not sleeping in or getting up late.
Excellent. Yeah. High level pro tip for the listeners. Re-listen to that right there. What are your hobbies?
And my favorite hobby is skiing. I thankfully now that COVID's over, I'll have skied 5 times by the end of the season in France, here in Europe. Another hobby is paddle tennis. I don't know if that's hit the States. It was invented in Mexico, big in Spain and Portugal. It's like a mixture of squash and tennis. Really good fun. And then cigars. I'm very keen cigar smoker when I get some downtime.
Okay, awesome. We have something similar in the States. We call it pickleball. I don't know if that's the same or not.
I don't know. I haven't heard of that.
It's like tennis with a flat wooden racket and a different ball.
Okay, yeah, it sounds very similar. I must look that up. Yeah.
Okay, awesome. Next one. What is the one thing that you do not miss about working for the man?
Politics. I have no time for the BS you get with politics across departments and regions, and I love the entrepreneurial small startup feel where you there's no glass door, there's no corner office, there's no BS.
Yeah, I love that. I'm gonna have to steal that. Pile of tricks. I've never heard that, so I like that one. All right, last one. What do you think sets apart successful e-commerce entrepreneurs from those who give up, fail, or never get started?
Yeah, it's a great question. I think it's hard to distill it into one word. Or to me, entrepreneurs are doers, not talkers, who simply never give up. In some cases, they may be stubborn because you have to be somewhat stubborn. Some cases, you have to be sometimes missing something. You're missing a chip in the old brain because you're just so crazy that you're dedicated to your cause, and you'll do nothing to be diverted. So it's hard to get it down to one word, but I would say doers, not talkers, who just never give up.
Excellent answer. And I was laughing there. Anybody on YouTube seeing that, I was laughing because my girlfriend actually tells me that I'm missing a chip. So I thought it was I thought that was hilarious. So excellent answer. David, you want to close out the show?
Absolutely. How can people, if they're interested in working with the Fortia Group, how can they get a hold of you?
Please email exits@the Fortia Group, TheFortiagroup.com.
Very nice. And we'll post links to all of that in the show notes. Emmett, want to thank you for being a guest on the Firing the Man podcast and looking forward to staying in touch.
Thank you, David. Thank you, Ken. Really enjoyed the conversation.
Thank you, everyone, for tuning in to today's Firing the Man podcast. If you like this episode, head on over to firingtheman.com and check out our resource library for exclusive Firing the Man discounts on popular e-commerce subscription services. That is firingtheman.com/resource. You can also find a comprehensive library of over 50 books that Ken and I have read in the last few years that have made a meaningful impact on our business. For that, head on over to www.firingtheman.com/library. Lastly, check us out on social media at Firing the Man and on YouTube at Firing the Man for exclusive content. This is David Schomer.
And Ken Wilson.
We're out. Before you go, we wanted to share a new service that Ken and I have been using called Getita that has made us over $10,000 in Amazon reimbursements. The service requires no monthly subscription, and Getita collects a small percentage of the money they recover for you. It takes less than 5 minutes to set up and works on all Amazon marketplaces. Go to Getita.com, Getida.com, and enter promo code FTM400. That's FTM for Firing the Man 400 to get your first $400 in reimbursements commission free. How much money does Amazon owe you?